think we actually already hit the record button, so it looks like we're live with a super clean intro. I think we are. So anyway, Matt, welcome on in. We're going to
Yeah,
dig
good to be here.
into, well, thank you. And I'm going to check and make sure. Yeah, it looks like we're live. So anyway, thank you everyone for your patience. But Matt, welcome on in from QCI Partners to talk about some activity in the bond market today. First of all, how are you, Matt? How's everything going?
I'm doing well. Glad to be here.
Well, I appreciate that. It's been quite a day, and I know you've seen some unusual things. We saw the bond market was already up to start the, or down. The yield was up to start the day. Then we had this unusual spike up to 1.6% at one point, and that came back in quickly. Yet you can see here, we'll go to the one-day chart. Even though it came back in, it still crept back up there at 1.47%. Here's the spike earlier in the day. Make of that what you will, or Matt, perhaps you can give some clarity. You see, even despite that, got just as high later on. So why don't we start there, Matt? What are you seeing, and what on earth happened today?
Well, there was a bit of a tough auction that spooked yields here. It's good to look at nominals, but it's also good to pay attention to the tips market too, the spreads there. And when you look at like 5 and 10-year break evens, they're really blowing out. They're near 10-year highs here. So people are looking forward quite a few years, anticipating relatively higher rates of inflation with us opening up the economy here.
Yeah, and Matt, do you think this is, we've seen a lot of headlines about inflation concerns. I don't know really what changed about inflation in the past 2 weeks. This strikes me more as people waking up to reality and quickly exiting the bond market. Here's the 1 month chart. Matt, how would you put in perspective that since January 26th, so in the last month, you've gone from 1.01% to 1.47%, especially if some people are a little bit newer to the bond world. Can you put that in context?
These are drastic moves. If you look at something, maybe some of your listeners are familiar with, like TLT, which is the long treasury bond ETF. It's started off the year here down over 10% in price. So when you're at interest rates this low, the price of the bonds can move drastically when yields are moving. And that's exactly what we're seeing. We're seeing a repricing of bonds here, and it's definitely affecting people's portfolios and how they're positioned.
Yeah, I would say so. And perhaps, Matt, I was thinking maybe we could go through some of these headlines. I'm also going to pull up the yield curve, which we will dig into at the end. But I guess I'll share what I've seen and heard in the last couple of days. I was surprised that on Tuesday, I'd heard about it. I guess it sunk in somewhere today that on Tuesday, the Fed stopped publishing the M1 or M2 monetary data. They stopped publishing something. Fed goes down on Wednesday for a couple of hours. This is in the middle of already the bond market getting pummeled. And I'd like you to share that story of, as a hedge fund manager, what you experienced yesterday or today or yesterday, rather.
Yesterday. Well, yeah, it was just kind of a unique situation where we were attempting to move some money, and I called one of the third-party brokerages we work with, and the guy told me, "Oh, that's on hold. ACH is down." And I thought he meant their firm's capability to transfer money. And I said, "Gosh, your guy's ACH? What about wires?" He said, "Oh, wires are down." I said, "Man, that's going to be tough on you guys, not being able to move money." He said, "No, the ACH is down." It was hard to even contemplate. I said, "What, you mean like the entire system?" So this was yesterday in the morning. So I called another broker we work with, and it was across the board. So it was kind of firsthand. I found out about that situation myself. That was very strange. I hadn't seen anything like that before.
Well, that answered the first question. I was going to say, have you ever seen anything like that before, which you just answered? Did you
No.
ever even conceive of something like this happening? Was this even a risk that you had entered your mind?
Well, capital controls, restrictions on moving funds are something that are real. They happen all the time. We've seen all sorts of draconian measures by governments, even things as bad as the bail-in that we had a few years ago in Cyprus that some of your viewers might remember, where they went in and took people's bank accounts away from them above 100,000 euros. So, I mean, it's something to be mindful of when times get tough. Governments, banking systems can take drastic measures. But in this situation where the actual plumbing effectively was just turned off, now this, without any direction, any discernible description as to what happened, this was pretty unique.
Yeah, because it's interesting. We still don't have any idea what happened. I mean, there's morsels coming out, floating around, and guys like you and I were researching what we can. Yet, all we know, I mean, you could have a fun time maybe on another show debating who did what for what reason, yet something went down. A couple hours later, we see Gamma Squeeze round 2. So we see GameStop going a lot higher. So whatever has happened over the past month returned right after this Fed outage. Matt, why don't you share any thoughts on that one first?
Well, I mean, this entire GameStop situation, it also calls into question some of the plumbing behind the scenes, because if you remember, they were halting people's capability of trading in particular names priorly, and they called in some of those CEOs as to say, what's going on here? So this is just kind of a reoccurring theme, I think. Back in 2019, we saw the repo market, which is the wholesale funding market. There were real questions there. It seized up, it locked up, and the Fed actually had to come in and bail that out. We're seeing illiquidity in the bond market right now. I mean, today in treasuries, to see such illiquid moves, that's relatively rare. And then this issue of funding and settling for the brokerage platforms, it calls into question just how that capital is actually managed inside the plumbing and what they're really setting aside for a rainy day. Interesting headline that you have there.
Yeah, well, that was hardly the only one. Let's take this one next, because in this incredible week, I think Jerome Powell said this Tuesday. I think he even said some form of it again Wednesday. It'd be Matt, maybe you even know the timeline. Was Jerome Powell actually talking about the inflation deficit while the Fed's system was down? Because here,
I'm not sure.
I'm curious, Matt, as a professional investment advisor, fund manager, are you concerned about inflation as much? He says it may take 3 years for inflation to hit the Fed's goal of 2%. Is that how you're pricing in your expectations too?
Well, I think one thing people really have to keep an eye on is the supply. I mean, the amount of spending is of a new scale. The run rate for the last 12 months out of the federal government is $8.1 trillion of spending. That's like 40% of GDP. These are amazing numbers and ratios we're discussing here. We're approaching 30 trillion on the deficit. So, and it doesn't look to be abated. There's no real discussion of curtailing it. So the supply side of those bonds is a concern. We have this situation where we're reopening the economy. from being throttled to varying degrees, which naturally, people in the bond market are thinking about a reflation in that. So there are a few components here with regard to his, 2%. No, I don't really manage to that, or quite frankly, think about it at all. I'm paying more attention to things like tip spreads, the differential between the inflation protected bonds and the nominal treasuries, which are printing higher spreads. That's a market that I like to really follow because it's smaller than the treasury market. It's more illiquid, and there can be more opportunity.
Matt, what about markets like gasoline up 70% since November, lumber up 52%, copper up 33%, Commodity Research Bureau's index up 26%. That doesn't seem like they're struggling to get over 2%. There's no sign of stoppage. On the day Powell was making these ridiculous claims, gasoline surged 2% that day alone. I mean, it's insane. And is there any connection between, this is 1136 today, less than 1 basis point away from convexity disaster. This one we covered, but oh yeah, here we go. And then 106, treasury yields explode after catastrophic tailing 7-year auction. How about I leave this one up and you can share any thoughts about what happened here?
Oh yeah, so this is the auction earlier today that I had mentioned. The important thing here is we have to issue tremendous amounts of bonds. Our deficits are extraordinarily large. There's no discussion about curtailing them. So again, supply is key here. Where does the demand come from? And where the rubber meets the road is at these auctions, at least at the primary market. So it's a data point. I mean, to see these go awry, to see problems in auctions, that's something you need to be paying attention to. This isn't price friendly, which means higher yields in bonds.
Matt, when you said where the demand is going to come from, I don't know, I'm assuming maybe it's going to be someone like Lagarde here. When she says ECB closely monitoring bond yields, what does that mean? They're gonna look at them. I can monitor the bond yield. I don't think that it's investors are worried about inflation. I think they're worried about people like her and their monetary policy. And she can say she's monitoring this. She can say the Easter Bunny's coming to round up the money supply and somehow, stimulate things at the same time. But in the end, all that they can do is print more money. So it's like the only play they have. And that's just is that not just going to exacerbate it further?
I think investors would be remiss in looking for a path forward or questions from Treasury secretaries or Fed officials or central bank officials. I just don't think that it's constructive, frankly. I think there's a narrative they have to perpetuate, and there are varying situations fiscally and monetarily. I mean, the ECB has a very different situation than the Fed, and the constituent nations over there are a different story too. But nothing looks that they're going to be letting up on the printing presses, to be frank.
So Matt, would you agree with, I'm going to read 2 sentences here. I mean, hey, this is this guy's opinion, so I'm asking if you agree. Auction was, in word, catastrophic, and no foreigner suddenly wants to even smell U.S. debt. Is that how you would interpret what we saw today?
Well, it was one auction, so it's a data point.
Right.
It's, again, something to keep an eye on. Foreign demand is something that's accessible to the data you can see through the Treasury reporting. But we're still sitting at relatively low yields. It's just kind of an amazing situation that the 10-year bond is at 1.5%. The 30-year bond is what, 2.3%. So we're coming from levels that are exceptionally low. And part of the reason that it's a talking point is because of that convexity that I mentioned earlier. When rates are low and they move, price of the bond moves drastically. So to paraphrase, when rates go higher, there are people losing a lot of money. And when you're buying treasury bonds, you're not necessarily speculating aggressively, let's say. So you weren't counting on that being a huge mover in your portfolio, and that's what's happening.
Especially if everybody's really levered up and really the only plan is to hope that the Fed pays more. Matt, would you agree with the conclusion here that the Fed better do yield curve control now, or else we are about to find out just how much absolute BS modern monetary theory really is? Would you agree with that?
Well, this is an interesting talking point that they are raising, and they're greasing the skids for what they're calling yield control. This is something that the US did undertake during World War II, but we have a very different situation, obviously, than the situation we were in World War II. And just for the audience, what they're actually saying is they will cap how high interest rates can rise across the yield curve. So they'll pick some arbitrary number, whatever it is, let's say 2% interest on the 10-year bond, and they'll stand ready to buy enough 10-year bonds such that the price doesn't fall in order for the yield to go above 2%. And they'll effectively flatten out the yield curve and mold it as they see fit. Well, everything has a cost. It's just like when countries peg their currencies. Like China pegs their currency to the dollar. You can't just proclaim this asset is worth X dollars. You have to go into the market and buy and sell and actively make that happen over time. And there's cost to that. So the trade-offs are real. Are they willing to actually get involved and do that? We'll see. But they're already openly discussing this as a potentiality. And it's something to watch. The yield curve is really steepening here. Interestingly enough, even with its steepening, financials, which tend to be buttressed by a steepening yield curve, were hammered again today. So this could be something that they're planning to move forward with if this continues.
Well, I think what you're saying makes a lot of sense. The only thing is, I think they do realize that. I don't think that necessarily is going to be what the decisions are based on. Any comment on this one? CTA, selling of bonds has gotten so relentless, it looks a little unnatural. I don't know if you caught this one earlier today. Here's Zero Hedge. The Fed really needs to make an announcement here. What is going on is not normal. Any thoughts on that, Matt?
No, I didn't see this.
Do you think, or in other words, do you think the Exchange Stabilization Fund or Plunge Protection Team or IMF or whoever was, wouldn't you have to think that on a day like today, there was almost all of the above?
Well, it's definitely causing some repositioning. We were coming from levels that were extraordinarily low with regard to interest rates. So when that happens, if you're managing a pool of bonds, fixed income, you have to think about your duration, your convexity. That just means how much money do I lose if interest rates go up by X%? And at these low levels, prices really move around. If your viewers want to see something amazing, go back and look at Austria. A couple of years ago, Austria issued a 100-year bond. And subsequently, the price relatively shortly doubled. And people just couldn't believe it because they were borrowing at a very low interest rate. But it had to do with an extreme example of bond convexity, where if interest rates fall and you have a very long term to it maturing, price can go up drastically. And this is the opposite. If they rise, price can fall. So, this is playing out. People are having to adjust, to hedge, to offset risk, and to be active.
Yeah, well, I would say so. Quite an adjustment. Looks like an adjustment in Australia as their yield curve control is on the verge of collapse. I don't know how closely you've seen that, but any quick thoughts on Australia's experiment? And of course, if it collapsed, that means the Fed's got to be getting jealous right now and thinking, oh, well, this looks like a good idea.
It's some of these smaller, thinner bond markets around the world are kind of a canary in the coal mine, something to keep an eye on. But we don't have any direct Aussie exposure to any degree.
Well, the canaries are falling over left and right, it seems like. Here we see vol correlation massacre means capitulation is just starting. I know there was something in one of these about the VIX. They were wondering if the VIX was going to hit 70. That's always good news for the financial markets. Continues to surge. Let's see. So the VIX did indeed spike, as you would expect. Shows that the VIX, which may be headed to 70 if the correlation we discussed in this week holds. Any thoughts on the VIX? I'll pull up the chart. What are you thinking there, Matt?
Nothing directly. Sometimes with a buildup of positions or derivatives, there can be a bit of a tail wagging the dog situation with the VIX.
Kind of like in the silver market?
It's funny how these things can work sometimes in the relatively shorter term. There used to be more ETFs that were holding futures contracts in VIX. Some of them got liquidated from your clients, or some of your listeners probably remember some of those blow-ups of ETFs where they were pooling those contracts, causing distortion and feedback loops through market pricing. But no, I mean, it's elevated. We're near 30 here.
What do you think you think the VIX is going to be up or down tomorrow?
Tomorrow? Oh gosh, I don't know. Day to day, for anyone to say. But I remember not too long ago, ironically, a couple of years ago, when we were seeing headlines and articles that the VIX was never going to eclipse 20 again. And, you see these things. And
did you saw that and you didn't send it to me?
Oh, this was, I think 2017.
Yeah.
But I'll find,
I can't wait to see that.
I'll find some of them. I'll send it over. It's
seems like that didn't work out too well last year. And I'm going to take a wild stab in the dark. I think we'll see the VIX over 30 tomorrow. Who knows? Maybe we'll see silver over 30 tomorrow. Quick note coming up in about 10 minutes, Wall Street silver. We're going to dig in and find the truth behind these rascals that the CFTC is monitoring. So folks, feel free to invite the CFTC to come watch. Maybe they'll learn something. Well, let's not be ridiculous, but anyway, Matt, given all that you just said about the bond market, I know you don't always discuss the politics on the air, but is a good time to be carrying out airstrikes only a couple hours afterwards? You can pass if you want.
I suppose. Okay. Yeah.
All right. We'll leave the airstrikes for another day. I mean, it's been a lot happening this week. Last quick one. Let's take a scroll or a stroll. I guess you could do either. Scroll through Zero Hedge headlines if we can get it loaded up here. It looks like a lot of people are searching this. And maybe while we load that, I guess my other question, Matt, was going to be, given everything that we discussed, a lot of red there on CNBC. Is it odd that the most important financial matter that they are seeing is the $15 minimum wage is not allowed in Joe Biden's bill, and stock futures mixed, bond market slaughtered. Uh, you know, nothing in here about the Fed being down. They're not even covering the airstrikes. So go figure. Matt, is this what investors should be concerned about right now, the stuff you're seeing here? And also, do you think the bond market is betting on a red hot economy? Is that what the bond market is signaling to you, Matt?
No, I think the reopening of the economy is one thing. We're not seeing commercial lending pick up in any measurable size. People need to remember that's where most dollars are created. Everyone's focused on base money, so you have to keep that kind of in context. I think people are concerned about supply. I think we're running tremendous deficits. We're not having a discussion as to what we're going to do about them. And that's kind of open-ended. And what does issuance look like? That's another question. As I mentioned earlier, Austria issued 100-year bonds. Do we start to issue longer duration bonds? One of the things I've been surprised about, to be honest with you, Chris, is why aren't we issuing 50-year treasuries? Why aren't we issuing 100-year treasuries? You're telling me Mexico, Austria, Ireland can issue 100-year government bonds, but we can't? You know, so maybe we see a push in duration, and you know, that starts to take place. But we're going to have to issue a lot of bonds. What does the mixture of duration look like? You know, we'll see. If we put it on the short end, that's kind of using the credit card. You got the variable APR rate on the short curve of the treasury, and this is a lot of debt. So how does that feed through the yield curve?
Yes, I think there is a lot of debt. I've actually been thinking about that for the last 10 years, Matt, because they say, well, or Bernanke was saying, well, we could just extend out anytime we want. Yeah, that's like me saying, well, I could trade against myself. Good luck finding, that's the thing. If they ever tried to actually refinance like people would do with their mortgage when the rate is low, I think that then they would find out rather quickly why that won't work, because there's going to be a rush to the 100-year U.S. Treasury bond. Matt, real quick, I'm just going to mention all the factors that Jerome Powell is feeling must be boosting the economy. California collapsing. Boeing makes emergency landing in Moscow. That sounds good. Baltimore strippers are protesting COVID. The power grid, which I learned earlier tonight, has started credit freezes and defaults. Japan's 10-year yield blows out above a barrier. Right. It's bananas. Home buyers, that's not a small chunk of the economy. Biden airstrikes. Gee, seems like a lot going on, and perhaps connected to the bond market. I don't know. Maybe it's all just a coincidence. In either case, I thank you, Matt, for joining me here tonight. We have to wrap up because we're going to dig into Wall Street silver in a couple of minutes. Although, Matt, as you and I were talking about earlier this week, a lot of people have been asking about the options and other related services that I'm not licensed to do, but I've been wanting to find for years a right way to set things up. So if there are people who are interested in something where I have some guidance, but it's all in place, and Matt, because you are a fund manager and have that infrastructure set up, can you quickly let people know just what's the best way to contact you if that's something they're interested in finding out more about?
Yeah, absolutely. We manage investment portfolios for institutions and individuals. Some of those are option portfolios. You can reach us at info@qcipartners.com.
All right. Well, I appreciate that, Matt. Thanks for breaking down the bond market today. Quite an adventure. I can't wait to wake up tomorrow morning, but we'll see how it goes. And I'm sure we'll be talking again soon, my friend.
Sounds good. Thank you for having me. Good to be here with you guys.
All right.